Well, good evening, everyone, and welcome to tonight's webinar. As everyone jumps on the webinar, feel free to let us know who you are and where you're from. It's nice to know who we're talking to. My name's Stacey, and I'm the social media and content manager here at Relab. And I'll just cover some quick webinar admin points before I pass on to Ben for the full introduction. I'll be managing the chat throughout the webinar, so if you've got any technical issues or general questions, I can try to help you out. I'll also be monitoring the chat for any questions throughout the webinar that will be answered at the end. You will receive a recording at the end of the webinar in your inbox later this evening. It will also be available on our Facebook pages and YouTube channel tomorrow as well. And just a little disclaimer that everything discussed in this webinar shouldn't be taken as professional advice. Please make sure you consult a professional before you do make any decisions. And cool, that is all from me. I will pass on to Ben.
Awesome. Thank you, Stacey. Welcome everyone to the Subdivision New Zealand webinar development series. Today, I'm very, very happy and excited to bring on board Richard Ashby from Gilligan Shepherd. He is a tax expert in this space with loads of experience. And obviously joined with me is my good friend, Kristy Merriman, also admin of Subdivision New Zealand. She'll be able to explain some of the key scenarios that we're going to go through today. So there will be three, and why don't you let the audience know?
Yeah, well, thank you very much for that, Ben. So what I want to start is we've picked three scenarios that we believe are the most common. We've seen them on the web, on Facebook, and also with the connections I've got to many of you on Subdivision New Zealand. But what I want to say is when I started off, I was swamped with all this vast amount of information, and I just want to stress to everyone, we cannot overlook specialist advice, in particular tax, to do with tax, and legal, to do with contracts. Many of us try to shortcut that and to go cheap and not get it. Problem is, it will bite you, and it will bite you very hard. So,
is this speaking of experience?
Well, no, it's what I've heard.
Yeah.
The amount of people that are not doing it, and I understand why, because I was seeking tax advice at the start, and it was actually hard to get it at the time. It was 2020. So what I found is that getting specialist tax advice actually looked at my particular position. The advisor looked at the situation I was in, what my intent was, my length of time holding, what the rest was, and gave me personal advice. And specialist tax advice does not constitute a request on Facebook, nor does it necessarily constitute a rapid-fire 1-hour consult with someone online. There are things such as GST, tax on gains and profits, how you structure and how you time things. So I made myself as familiar as I could with tax law. What's that big? The technical section of the IRD, although I think it's been populated a bit more since. And I also had my new accountant, because I changed accountants throughout. He's a general accountant, but he puts our specialist property development tax to a specialist. Now, I'm in Auckland, but my accountant and the specialists are in Dunedin. So you don't need to have your advisors in the same city. So what I can say is I stress the importance of a specialist, and hence our discussion and asking Richard if he would be happy to talk to us and answer our questions. In our coffee last week, having a decent chat and pulling together scenarios. So first of all, without holding things up too much, Richard, we gave you the first scenario, and that was what I think is one of the more common infills, and that is where we have one full site. People are currently living in the only house on the site. Conveniently, it's at the front and it's to the side. Right. So there's a nice 3-4 metre driveway access on the side.
Perfect driveway.
Yes, perfect. Everything about it is perfect. Yes. It's neat. It's got perfect soil. The next door neighbours have got exactly the same, but their soil isn't perfect.
Right.
I'm just flagging that, as you know why.
Yes.
And they've got space to build series of 3 slim homes where they want to rent out for long-term income.
Okay.
So, Richard, what are you going to say to these people?
Right. Well, the first thing I would say to my clients, I basically have and what I'll apply for all 3 scenarios here, is I have a sort of, I guess, a logical process that I go through in my mind.
Yeah.
Whenever a client approaches me and says, this is what I want to do with my land.
Yeah.
Now, in a scenario like this, the first thing I ask them is, well, what was the land acquisition date? And that's important to me because it then sort of tells me of the various taxing provisions that may apply to them, how many of them can I knock out straight away?
Can I tell you that they're fairly recently married, in my terms, so 3 years is fairly recently.
Okay.
So they acquired it as a wedding present.
Okay, so straight away I'm thinking, if I go through my logical process, that there is a rule called the minor subdivision rule. And basically that applies to any person. So myself as an accountant, as a tax advisor, if I own a piece of land and I decide that I want to develop or subdivide that land into lots,
yeah,
and I commence that subdivision scheme within the requisite time period, which is within 10 years of buying the land,
yeah,
then I potentially have a taxable subdivision. We refer to this taxing provision as section CB12. Okay.
People can find CB12 online quite easily, can't they?
Yeah.
IRD
You just
website.
mentioned, you just mentioned the IRD website before, and I've got a couple of just tips for the audience here about if they like to do their own homework. I'm going to suggest a couple of places they can look at to answer some of these questions. Now, so basically CB12 just looks, there's 3 main components to it. Have you commenced an undertaking or scheme to develop or subdivide your land? An important point there is, once you're deemed to have commenced your scheme, it doesn't matter if you then abandon it, okay? Commencement potentially triggers the taxing provision. So then it's a case of saying, okay, if I have abandoned it, can I show that my scheme was not for the purpose of sale? I would say applying for a resource consent for another reason. But I never
can tell
intended
you,
to.
these people want to just rent.
Yep.
That's their intent.
Yep. So the first thing I'd say is to them, the issue is, are you going to trigger section CB12? And the final component there is the work involved in your scheme going to be more than minor in nature? Okay. Your question to me is going to be, well, what does minor mean?
Exactly.
Now,
and I've also flagged that the site is perfect.
Right.
Yeah, it's not South
the
Auckland
ideal.
land, it's not city land,
Yep.
it's not only Hunga land.
It's flat.
Okay.
There's the soil.
Well, until August 2020, it was a bit of a guess in terms of looking at the various cases that have gone through the courts in the past, in terms of what did that minor terminology actually mean. And then in August 2020, the IRD put out an interpretation statement, IS 2008. So first place you can go to do some homework is if you're doing a subdivision within 10 years of buying your land, go and have a look at IS 2008, because it talks about what is the meaning of minor. Now, within that interpretation statement, there's a couple of cost thresholds. Now, if your absolute cost to do your subdivision, excluding reserve contribution fees and resource consent application fees, if the remaining cost, and excluding the build work, sorry, if you're putting dwellings on top. So if your absolute costs are more than $50,000, then you're not going to tick that box. Under 50,000, you tick one box.
It's likely to be more than 50 because we put a driveway down, we have to take drainage down, and we have to get more water down.
Or 5%.
Yeah, or the other. Yep. Or the second cost measure is your absolute costs. How are they relative to the value of your land when you commence your scheme? If the absolute cost to relative value of the land at commencement of the scheme is less than 5%, then you'll tick another box. Now, if you tick both those boxes, you can be fairly confident that your work is not going to be considered more than minor, and therefore you won't trigger section CB12.
Yeah.
Now, there are a couple of things IRD says in this interpretation statement about if the character of the land is significantly changed, if the legal works or the professional services work is quite complex, then regardless of you satisfying those cost thresholds, they might still think it's exceeded the minor work. Okay, But ticking those two boxes is a good start. Now, if there is a taxable subdivision in place, so they've exceeded the 50K,
Yes.
and the work's going to be more than minor in nature, the next step I move on to is the legislative exclusions. Is there an exclusion from section CB12 that they may be able to claim? Now, there's 4 exclusions. Now, in this case, 2 of them, which is the business premises exclusion and the farmland exclusion,
It doesn't apply.
clearly not going to apply.
Doesn't apply. Yeah.
Okay? So the next question to my client will be, who owns the land? And whose name is the land? Is it owned personally?
Oh, it's a family
Jointly?
trust.
Is it in a family
It's
trust?
in a family trust.
Oh,
So, yes, well, unfortunately, oh no, because of the other 2 remaining legislative exclusions. The main one is the residential land exclusion, which basically says if you have lived on the land before you commence the subdivision and it's less than 4,500 square metres, then you can claim the residential exclusion. The carve out is that exclusion does not apply where a trust owns the land. And I've had a number of clients caught out because they've come to me, I've asked them who owns the land, I've said a trust, I've said, well, sorry, at the moment, this legislative exclusion does not apply to you. Now, that's quite out of sync with another residential exclusion in the land tax provisions, which does permit a trust to own the land and you can claim the residential exclusion. So there's a legislative mismatch there, but no real motivation by the government at the moment to change it. They've got too many other things on there.
And there's
on the plate.
they'll lose tax and profit.
So if you tell me that it's owned by an individual, then I'll say, okay, how big is the land? Because again, if it's less than 4,500 square metres, you're on your way to being able to claim this residential exclusion. Okay. If it's the remaining exclusion is what we call the investment land exclusion. Okay. So if you are doing the subdivision for the purpose of deriving rental income from the completed lots, which you are in this case,
And that's the full intention.
then you're likely to be able to claim the investment income exclusion. So section CB12 will not apply to you. But it doesn't end there, unfortunately. That's just one taxing provision. The next one we need to consider is tainting. When you bought this piece of land, were you associated with any person in the business of land dealing or in developing or subdividing land? If you are, then there's a 10-year tainting period. So even though you have nothing to do with those businesses, if you're associated, and there's a legislative associated persons definition, which you can work out if you're associated or not, you also need to be aware of tainting issues. So that's the next thing I'll ask my clients. And they'll say, no, I know nobody.
Absolutely, no one, they know no one.
And then we get to, I guess, what's always on the tip of people's tongues these days, the bright line rule. So you notice I didn't talk about it at the top, because in the legislative pecking order, it doesn't actually come in until you've considered all those other taxing provisions. But as most of us know, if you buy land within the bright line period, so since October 2015, when it first came in, it's gone from 2 years to 5 years and now to 10 years. And you sell within the bright line period, the bright line period usually commencing when the title of land is transferred to you and ending when you enter into a binding contract to sell your land. So if that period is shorter than your relevant bright line period, then you have a bright line tax issue. And there's very few exclusions from bright line. Okay, the main home exclusion, there's 2 types now, depending on when you acquired your land, because they've got the pre-27th of March 2021 rules and the new post-27th of March 21 rules. But other than that, unless it's transferred to you by way of relationship agreement or it's upon death of somebody close to you, you're going to be paying bright line tax, even if you can get around all these other exclusions.
We don't have any inheritance tax here.
And even if you get past, and even if you get past bright line, the final consideration for this scenario is, has there been a change in the land use rights for your section? You know, when you bought that land, could you do your 4-lot subdivision you're going to be doing now?
No.
Or has there been a change in the unitary plan that's enabled to do that? Now, if that's the case, then it's likely another section called CB14 may come in and get you at the end. The good thing about section CB14 is it actually has a discount. So for every year that you've owned the land,
Yeah.
you get a 10% discount off the amount of your profit that may be subject to tax.
Okay.
Okay? So the basic rule you need to work out is, am I selling within 10 years?
Yeah.
Because this taxing provision is triggered by the date you sell.
Yeah.
If you're selling within 10 years, does more than 20% of your disposal gain
Mhm.
relate to that land use change? So you're going to need to get a valuer involved to work
Nice.
this out.
Mm.
If it does, then your whole gain is taxable,
Mhm.
but then subject to the discount. Okay?
Yeah. So
Okay,
10 years,
can,
would
so
that
in,
be
in short,
10% per year?
Yes, yes, yeah, yes.
so in short, just interested in sticking to our time.
Go to the next
We have
scenario.
they've only had it for a short while.
Yes.
You're very clearly given, thought points running down. And because it's owned in a trust, they may fit within the, still not have to pay tax on profit because that's not their intention. They are doing it for long-term investment and they're not tainted. So yes, great.
Yeah, I think as long as you covered off those, they'd still have to be aware of the relevant bright line period. Now they're sticking new builds, what we refer to as new builds on the land. So at least it'll be actually I should back up a bit on that. When you subdivide your land, it doesn't change your bright line period. Okay, your bright line period is always commences with the original lot purchase. So if they've owned it for 3 years, even in year 4, if they subdivide that land into 3 new titles, it does not create a new bright line for each of those new titles.
So from
They
the
get original.
start, yeah,
Yep.
but they are intending long-term hold. They will probably be holding for 15 years.
Yep.
Things theoretically be fine, but
Yep.
we would suggest they do need to get specialist tax advice.
Yes, I agree with a lot of those sentiments you made up front. Yeah.
Okay, well, I'm going to move on to the next scenario. So this here is a full site. It's been owned and lived in the house on the site for 18 years. And the intent is to build terrace houses on that site.
Okay.
I think it's 8 of them.
Okay.
That's my intent.
It's a nice development.
Hopefully it's pretty, it's effective and we get it done in time.
Okay, so I guess, straight away in my head, you're telling me you've owned the land for 18 years.
Yeah.
Okay, so immediately I can carve out, clearly you did not buy this land with intention of sale.
In fact, it couldn't be divided at all at the time.
Yep,
Mm.
so you couldn't have done what you're going to do.
Good point.
Clearly it's not subject to bright line, where we're assuming we're in real time, so it's
Yeah.
well before October 2015. Clearly you're not going to trigger section CB12
Mhm.
because you're commencing your scheme after 10 years,
Yeah.
so you can never trigger section CB12. Section CB14 is not going to apply
Mm.
because even if there's been a land use change, you've still held the land for more than 10 years. So you might be thinking that you're on a winner. There's just one more land taxing provision we need to consider, and that's referred to section CB13.
Yeah.
Now, section CB13 is similar in vein to the way section CB12 is worded.
Mm.
Any person,
Mhm.
so I don't have to be a developer, which clients often say to me, I'm not a developer, so it doesn't apply to me.
Mm.
Sorry,
Any
there's not.
person.
Yep, it just talks about any person, and person in the wider sense, company, trust, partnership.
I see.
Okay. So any person who commences a scheme or undertaking to develop or subdivide their land, any time period, but usually because section CB12 applies first because you just need more than minor expenditure.
Mm.
CB13 normally comes in after 10 years.
And it uses that word significant.
Yes, and that's
And significant was not qualified when I began mine.
right. So
Yeah.
you had a lesson in learning what
Oh,
does
yes,
significant
what's
expenditure
significant
mean.
mean,
Yeah.
yes.
Well, again, if you go to this place on the IRD's website, the tax technical section,
Now.
and put in the word significant expenditure,
Now they have it, yes.
it's going to come up with what we call questions we've been asked, QB 1502.
Mm.
And essentially that QB talks about what is the meaning of significant, okay? Now, there's a couple of things the IRD says that it includes, and a few things they say it doesn't include, okay? So when we're looking at CB13, essentially we're only looking at development work to the land, both physical and non-physical. So when you're doing assessments around cost and relative value that I'll come to soon, similar to section CB12, you can remove costs that are purely divisional, say surveying for drawing up your lots, as opposed to surveying for build or developing the land, earthworks or something. You can remove those from your equation. And also, interestingly, and the courts have given this their sign of approval, is you can remove from your equation future expenditure yet to be incurred. So I say to a client, okay, you've got a site that adjoins the roadside. Can you perhaps do it in stages? Can you complete your roadside lots first, dispose of them, and then move on to your next stage? Because what the revenue has agreed to, and you can read about it here in QB 1502, is it's only when you cross the significant expenditure threshold that everything after that is taxable. So you may be able to do these first front ones at a lower cost, because they don't need driveway access and those sorts of things.
What was the threshold?
But there's no monetary threshold in this regard. It's just looking at what's significant. Now, if you read this QB 1502, towards the end, there's 3 examples given by the revenue to explain what they mean. And you will see that those 3 examples will probably not shed any new light for you on what does significant mean. And that's because when we talk about what the IRD does consider, there's 3 components, okay? Again, there's absolute cost. What did it actually cost you? And we're talking now the development costs of both the physical and non-physical nature. What did it actually cost you to do your scheme? Okay? And you've got to say, is that significant alone on a standalone basis? Now, one of the revenues examples says the absolute cost was $200,000. Now, in my head, that doesn't sound like a lot of money when you're doing a subdivision scheme like this, or development scheme like this. Now, the IRD's view is that triggers section CB13. They believe in anyone's eyes, $200,000 is a significant amount. Therefore, they say it triggers the taxing provision. The other thing they look at is now under CB12, you just had to look at the absolute cost versus the commencement value of the land. With CB13, you look at both pre-commencement and post-completion values. Okay. Now, from everything I've read, and there's a couple of court cases, but they're quite old. If you're getting over 10% in any of those relative assessments, you're probably getting into muddy waters.
So what I'm going to do is we've kind of covered significant and see if we can get through the next thing so we can make time for questions.
Yeah, okay. So, and the next thing is the intention, you know, so
to sell.
So if you're going to sell, then, you know, arguably you're going to trigger section CB13. If you're going to hold, then you might be able to argue the residential investment income exclusion will apply to you, even if you've done significant. Again, I'm going to ask who is the owner of the land. Now, I'll ask that because even though you're doing 8 units here, because of how we can squeeze things on a section of land these days, you can still claim the same residential exclusion if your land is less than 4,500 square metres.
But it was bought in a company because the intent was to sell. So that's the key thing here.
Oh, no, but this one's been open for 18 years, hasn't it?
Yeah, I know.
So,
but their startup was, so they decided they were building and selling.
Okay. So in this case, therefore, they won't get the residential exclusion. So then I'll also move on to tainting. Now, the reason I raised tainting here is because of the associated person rules. There's quite an interesting one that people often overlook. And that's if you're associated when you buy the land with, if you're associated when you commence your improvements to the land with a person in the wider sense of the word, including companies, who carries on a business of erecting buildings, then, and you commence your improvements when you're associated to that person carrying on their building business, from the date that you end your improvements, so you complete your project, you have to then hold the land for 10 years, otherwise you're taxed by association, okay? people don't think of this because they think they've held their land for 18 years.
Yes.
But this curious rule can basically restart the 10-year clock
That's actually really
based on
important.
improvements.
Yeah.
Yeah.
So it's
So
when
it
they've
can catch
finished their
people out.
development, they've got another 10 years to hold.
If they've got that builder's association.
But as we said, for this scenario, we're trying to reflect what's common out there. And
Yep.
that was,
So it's
they
probably
know what they've got.
unusual.
Yep.
Most people say to me they don't have this association to builder, so we can just clear that. Now, having covered off all the land tax provisions, you might think you're home free.
Yeah.
What I've seen recently though is there's this section in the Act called Section CB3, and all it's titled is profit making undertaking or scheme. And I've seen the revenue. I have a live case at the moment that's going to adjudication, where they've tried to get me on all the other angles, and they can't. But the one they're coming at me on is that my client commenced the subdivision scheme, and it's a profit making undertaking or scheme. Therefore, Section CB3 applies. There's not a lot of law around it in respect of land. A lot of commentators say, well, if you've got the land tax provisions, and you can satisfy all those and not be taxed, why should you be taxed under this profit-making undertaking or scheme provision? Unfortunately, the courts have thrown that out and said, well, it doesn't say that the revenue can't apply this. Yep. So they'll rely on it if they can, as they are. But it does look at your dominant purpose.
Yeah.
So as opposed to an incidental purpose to make a profit, your dominant purpose must be to make a profit. If you're ticking that box, then you may have a Section CB3 issue, even though you've got around everything else. And there's no time limit. So again, you've owned the land for 18 years, it can still apply. The final one that I'm going to talk about here, and it's surprising how many people overlook it, is GST.
Yes.
People just think, I'm not in the business of development. I might consider my income tax issues, but so many people don't think about GST. And it's not until someone maybe actually had a recent case where it was the architect on site just mentioned to who became my client, because then he knew he was in trouble.
Yeah.
And he said to him, what about the GST on this side of things? And my client said to him, well, no, I'm not a developer.
Yeah.
But if you look at the definition of a taxable activity for GST, which then triggers the requirement to register for GST if you're going to exceed the taxable supplies, a taxable activity is simply any person is looking to supply goods or services to another person for a consideration on a continuous or regular basis. Now, most of that's pretty black and white. And you'd say, if what you're doing here is basically you've owned the land for 18 years, you're doing an 8-lot development, and that's you plan to sell. So you say, I'm going to be making a supply of goods to another person for a consideration. The issue here is what you're doing either continuous or regular. Now, both the court and IRD have said, if it's a one-off project, it can't be regular, because regular normally means a number of
You've got multiple sites
and projects going on. Now, when it comes to continuous, which is from a subdivision perspective, is when people normally get caught out. The more lots that you create in your subdivision, and the more work you do on those lots. So
You
say
sell them all at once.
say bare land versus selling developed lots, the more likely you're going to be deemed to be carrying on a continuous activity, and therefore GST will apply.
But for the backyard developer or the small infill, as a result of the unitary plan changes, they're building 8 lots. They're all sold, pre-sold, and they're all settling on the same day. That's not continuous.
I can tell you now that the same case that I've got going to adjudication where they're trying to get me on Section CB3, this involved an elderly lady who was looking after her family, and she subdivided her lot from 1 lot into 2. They erected a dwelling on the front lot, they lived in the back lot. They sold the front lot, IRD came knocking on their door. Now, this is how we've been able, now I could say personal residence exclusion, because owned in her own name, less than 4,500 square metres. So the IRD didn't like it, but they've had to stick with it. It's not bright line because it's pre-2015. So they're going for profit-making intentional scheme, but the other thing they're going for, interestingly, is GST. They consider that the mere fact, if they said to me that if the taxpayer here had just carved off the front section and sold a bare land lot, they would have been okay. The fact she went the next step and she erected a dwelling on that lot, moves it into the taxable activity for GST. Now, there's no support for this.
Yeah.
But with the revenue, of course, it's who's got the deepest pockets. And that's why my client at this time is going to adjudication. And we're hoping this adjudication, which is like an independent review of the IRD's case, they'll come back and say, no, there's no GST payable here. Now, I'm a bit suspicious about the IRD's GST position here, because when we were trying to negotiate the dispute, they offered to me that if you agree to the income tax position, we would withdraw the GST issue, which suggests to me that maybe they don't think their case is so strong. But based on my experience, what you've said about even if you sold everything at once, if you're doing an 8-lot subdivision, because that's typically what you're doing, 9 times out of 10, the revenue is going to say to you, that's GSTable.
Okay,
Yeah.
so that sounds...
Which is disputable.
Yeah,
you can argue.
But the other comment I would have is it seems to be that support for trying to build new homes and make it incentivize dividing up your backyard is not really there from the IRD.
Well, they do give you an incentive in terms of bright line. You only have a 5-year period instead of a 10-year period if you construct new builds on your own. But they don't care. It's not about fairness.
Yeah, I know. So anyway, to wrap up this one, it seems like there are several steps as well, and again, having specialist tax advice and being very clear on GST, and also having hat on understanding that not everyone in the tax department is going to be encouraging you to divide up your backyard.
Yes, you got some very interesting characters at the IRD.
And the risk you need to take to do that,
yes.
Especially through probably the past couple of years and maybe the next 2 years going. You have to think very carefully about what you're going to make out of it, if anything, or long-term investment. So now I'm going to move on to scenario 3 to try and keep this tight, which is slightly different.
Yes.
And that is recently, it's a complicated one for you. So I'll try and keep it tight if we can. It'll probably cover a lot of the bits that we have discussed. So very recently I purchased a large site, well, actually not me, but many people have done this. And I've decided to build a block of 2 units. So one block will be sold and the second block will be held to rent out for long-term income. So in my mind, I'm thinking if I sell the first block, that's going to kind of pay my debt down to allow me to more comfortably generate a family cash flow long-term. I'm not quite sure the balance of everything, but this is where my mind's sitting at the moment. So I've come in to see you, and I've come in early on because I know
that's a good start. Yes.
So
you got me on speed dial.
Absolutely.
Early.
Yes,
You're
that's
early.
right. It is right.
So you're going to run through this scenario.
Yes, and I have certainly had these scenarios put to me. And just stepping back a little bit, just one thing I'd ask is, what was your acquisition intention? Now I know you've said here there's a hold and a sell, but I wanted to become very clear to my client that if on the date they signed the binding agreement to buy the land, they actually intended to develop and sell everything, then you can't change that intention. You've triggered what we call Section CB6, which is intention of resale. The land is then taxable whenever you sell it. Okay, so just be mindful. A couple of things, that the onus of proof is always on you, not on the IRD. Interestingly, they brought in the bright line test to cover the existing intention of resale test, because the commissioner found it too hard to challenge people's intentions, even though the onus of proof was on the taxpayer, not on the commissioner. The other thing to be very mindful of is what you tell other parties before you're buying the land. If you're going to your bank and saying, yep, lend me $3 million, your security is safe because all I'm going to do is develop this and sell it straight away, that more than likely they're going to note that on your customer file. It's discoverable by the IRD. When you're later on trying to say to the IRD, no, my intention was to build some and to hold some. Okay, so be very careful about what you tell other people. Now, in your case, you've said, I had a clear intent when I bought this land to hold some and to
For long-term cash flow
to sell
investment.
Yep. So again, because we've moved on from intention, the next thing is we're back into in this case looking at section CB12, because that's basically the next, the minor subdivision rules. Arguably here you'd say that, well, I'm going to trigger that. I'm going to commence my scheme within 10 years. Clearly the work involved is going to be more than minor in nature. Okay. But I'm going to hold some and I'm going to sell some. Okay. So because the section CB12 looks at, are you doing the subdivision for the purpose of selling the land or for some other purpose? So you might have to pay tax on some of the land, but you may be able to claim the residential investment income exclusion for the remainder land. Okay,
but if you made no profit on your first block,
you'd have to be careful with your profit allocations, of course, because the revenue is going to be thinking
they will look into it.
They've always got the benefit of hindsight, so they're going to look into it. Now, I talk here about what we call a non-legislative exclusion. Okay, because you might say, what I'm doing, there's no legislative exclusion for it. But, for example, I bought land with the intention of resale, but I didn't intend to sell at all. I bought land with the intention of doing a subdivision to sell some of the land, but I didn't intend to sell it all. So questions been asked to the IRD, and I didn't note down the document number for this. But what if a legislative exclusion doesn't apply to me? Can I still have my subsequent disposals of, say, the rental properties exempt from tax? And the revenues come back with saying yes, but the onus is on the taxpayer to show that those lots that were retained, so in your case, there's a block of units retained to derive investment income, that was your intention when you did that, okay? And again, they'll always have the benefit of hindsight. So I'm always telling my clients, it's nice if we can, in this case, we should be able to rely on the residential investment income exclusion for those plots you're going to hold. But what if the IRD challenges that? Is there some other way we can also show to them that you never intended to sell that land, and then go down the non-legislative path of trying to claim? Okay?
I see.
Now, if you can get around section CB12, section CB6 intentional resale, you can get around section CB12, then of course you've got good old bright line sitting there. So you've just bought your land and you're going to hold some. You have to remember, of course, it's still subject to the bright line period for those retained units. Now you're putting new builds, obviously, so at least it's going to be a 5-year test
instead of a 10,
and not a 10-year test. Okay, but you need to keep that in mind. And of course, your general tainting as well. If you sell any of those retained units in a 10-year period, and you have associations with developers, dealers, builders, subdividers, you may have a tainting issue that can also catch you out. Okay.
I said, don't marry a builder or a planner or anything like that.
And then, of course, we got the whole land use change as well that we talked about before. It comes along at the end, just before section CB13, but it jumps in there and says, this thing that you're doing now you've just bought the land, so it's probably not applicable in your situation. But for someone who's had their land a little while, has there been a land use change that now permits you to do
like a unitary plan?
Some change under the Resource Management Act or environmental court ruling or something like that now permits you to do something you couldn't do when you bought the land. And again, if you're selling within 10 years, then you need to, these retained lots, then you need to consider the application of section CB14 as well. When I sell those retained units, is more than 20% of my gain as a result of that land use change? If it is, I've got a potential taxing issue under section CB14. There is an exclusion, but we won't go into that here. If I am taxed, then of course I get a discount for every year that I've held on to those retained. Now, of course, you would have had to hold on to them for at least 5 years to circumvent bright line.
And what was that discount?
And that discount's the same. It's 10% for every whole year. So it's not calendar year, it's not income year. It's just looking at the date of purchase.
Oh, okay.
So it's just your anniversary date.
Yeah.
How many anniversary dates do you have since you acquired your land? and that 10% each time gets you a discount. So if you had it 9 years, you only pay tax on 10% of your gain. Okay. And of course, we also have GST issues.
We touched on
But this one's a lot more difficult because you've got some of the land that you're looking at selling.
Yeah.
So clearly that in itself may create a taxable activity for you.
Yeah.
Because you're going to trigger all those basic principles, and the more lots you create, you'll be doing continuously. And then you'll have some land that you are developing for the purpose of deriving exempt supplies from, because residential rent is an exempt supply for GST purposes.
Yeah.
Now, what you need to be careful, and depending on who you bought the land off, for example, if you're making a second-hand goods claim, and you want to have this argument that I've did some to hold and some to sell, then you want to make sure when you make your claims, they're apportioned, you're making apportioned claims fairly. You're only claiming for GST purposes those costs that relate to the GST taxable side of things and not to the exempt side of things. Okay.
Right, so that's quite complex, really.
Yes, that one does get quite complex when it comes to
one,
GST issues.
And the main thing I've learned out of all of this is I will steer clear of relationships with any builders or anyone that could
How do you
attack me.
define associated person anyway?
It's legislatively defined.
Yeah.
Now, the general associated person rules, which apply for most of the Income Tax Act, is very wide. It's very hard to get around. In terms of anybody that's sort of closely related. I mean, obviously friends and that you can get around it.
So I know Kirsty.
Yeah.
No, you're tainted now.
But then there's trust issues.
Yes, there are
Trust
issues.
isn't trust. You trust each other.
Okay.
But the biggest, I guess, the catch-all for associated persons is what we call the tripartite test. And basically, if you're associated to Kirsty, now you could be a trust, companies, whatever. Yeah. And then I'm associated to Kirsty under a different associated person test, and suddenly you and I are deemed to be associated persons. Okay, so if you're a developer and suddenly I've become associated to you, and we've had that association since I acquired my land, then I'm tainted for the purpose of land tax rules. So, but it is a legislative definition, and
So have no friends.
yeah. But the good thing is, at least the associated person's definition for land transactions is slightly narrower than the general associated person provision. So they put some carve-outs in there. So you may be able to get around the association for.
I think they have a definition online as well.
Yep. Anyway, everything's searchable. So you can either search legislation.gov.nz and find the Income Tax Act, or you can go online onto the ID website, and you can probably put associated persons in there and it'll come up with some stuff.
So thanks for doing scenario 3, and
Do I have to give an answer on that one?
It seems far more complex. It is,
Yes.
and it's going to have a whole lot of other things involved with it we won't even touch on now. But what I'd like to do is hand back to Stacey for some key questions, and maybe if Ben, if you have a look at the questions as well, because we'll see some of the ones that may be pertinent, quite relevant.
Yeah, sure.
So if you want to pull up the question bar, and maybe you can put them to Richard.
We do.
Yeah.
One person asking for your contact details, Richard.
Do you want to just say who you work for? I know that was said at the start.
Yeah, I think it'll be on the links anyway, but it's Gilligan Shepherd. You can find me. We're in.
We'll include all the links in the show notes below later on, and Stacey would have that for everyone as well.
Yeah, cool.
Yeah.
Do you mind if I pull that forward because my eyes are so old? And
then
I can
keep my own. Going to read them out.
She'll but with the things we could maybe see some of the quite. So here's one I would just say. Does an ex-partner count as an associated person?
Wow.
It's a good question, actually.
Ex-partner in terms of business or relationship? So,
let's say both.
Well, an ex-partner from a business perspective would no longer be a partner.
Relationship.
Yeah, so I'd say a relationship, I'd have to look at the definition in terms of the associated persons on that. Because it does talk about, my initial thought is no, because I recall the wording of the definition is persons who are in marriage, civil union, and maybe de facto. So I think you tick all the boxes there to say, unless you're still legally married, you may have.
So there might be a loophole there.
There might be, but I think if you have clearly separated, I'd certainly be arguing to the IRD that you shouldn't be caught.
Just a quick question though, do they actually go and check? Like, how does this process work with associated persons?
Yeah, well, it depends on the person.
Yeah.
You know, a lot of these things. I think the other thing it's probably quite good to stress is the IRD has a huge property compliance team. Naturally, because there's lots of dollars involved, and the government expects to get a return for its investment. Okay.
Good after you.
So, and with the land, and the land transfer system is obviously online, and the revenue has just upgraded their own IT systems. They have a very smart computer system. And
very
basically
expensive as well.
Yeah, and all they have to do now is essentially match up somebody who's sold property within the bright line period, because they'll have that data. They'll check that person's tax return to see if they've reported any land sales income, and they'll just send out a letter saying, please explain. We get these quite often, where they'll say, we know you've sold within the bright line period, we've checked your tax return, there's no land sales income, please explain. And there may be an explanation around it. So that's often the first trigger point. And it's the other thing I'd stress is it's one thing to get good advice up front. It's another thing to get really good advice if you get an IRD inquiry. If the phone goes and it's someone from the IRD and they want to ask you questions about your land, just say, I'll get my accountant to call you. Yeah. Or I'll get someone else.
Just like a lawyer.
Because it's very hard. First impressions count. I mean, it's such a catchphrase. Yeah. But before you know it, you've told the IRD the wrong thing innocently. Yeah. And they'll have that on record. And then it's very difficult. That's human nature.
That's why you need a tax advisor early on. But I'm going to go on to some particular questions that's come up.
Let Stacey read them out.
No, we'll pick some of them rather. Okay. Yeah, if that's okay. Because what I want to do is make sure they kind of align to what's going on. So here's one in particular. We bought a 769 square metre 61 built house in May 17. And they built another 2-story, 3-bed in August 21 with Triple C issued without subdividing. They now have a plan to subdivide within a year, and if they sell the new dwelling, does the bright line rule apply? Is that too complicated?
It's just trying to read the.
So bought the section in
2017, did they?
Yes, 2017. May. Yeah, 2017. So 5 years ago. Yeah. And then,
so if you bought the land in 2017, then for determining whether bright line applies, which rules apply? So we're talking about no rules pre-October 2015, a 2-year rule, a 5-year rule, or a 10-year rule. Yeah. The first thing you look at is what date did you sign your binding agreement to buy that piece of land?
So that date on that contract matters more than the date on the settlement, correct?
Correct. Yep. So if you bought your land, so in this case, if we assume the contract was signed in 2017, the bright line rule at that time was a 2-year period. Okay.
Yes.
So
and March, right? March was the cutoff.
March 2018 was when it changed to 5 years.
Ah, yes.
Okay. So Brightline cannot apply to this situation, even if you create new titles, because Brightline just looks at the original lot of land. It's clear law that when you subdivide your land and you get issued with new titles, those new titles do not have a new Brightline period. It goes back to the original 17. Lot. Yep. So in this case, 2017. So I'll be quite confident that that Brightline won't apply to you. But again, and I haven't quickly read through the facts, you'd be wanting to look at section CB12 because you have commenced, or you will commence the subdivision scheme within 10 years. You may have already commenced a development scheme, depending on what you have to do to your land to make it ready for purpose. So that's probably where I'd be more worried about, because once you trigger section CB12 or section CB13, it then doesn't matter when you sell the land. You know, we're talking if no exclusions apply to you. Once you've triggered the taxing provision, then it's taxable whenever you sell it, unless you can claim an exclusion.
Even after 10 years?
there's no 10-year rule,
Yeah, no,
which
yeah.
a lot of people get confused about because
Yeah.
they just say, do we just have to hold it to 10 years? So, yeah.
The other one I thought that immediately was quite relevant was from Amit. Can you please touch on interest tax deductibility scenario? Yeah, because this is with people driving rental income. So scenario to be one lot subdivided into two, sections sold within a few years, and the existing dwelling on lot one kept until bright line period ends. Can I deduct interest on the existing house?
Okay, so I didn't quite take all that in,
but
but essentially, if I can say, the basic rules with interest is that if you had pre-27th of March 2021 interest, that's what we call grandparented, so then you're subject to a phase out until March 2025 when it will reduce to zero. If after 27th of March 2021, you then add if you add a new build to your land after and the CCC is issued after 27th of March 2020, okay, then that's referred to as a new build, and then you should be able to get interest deductibility for that portion of the land that contains the new build,
but not the old
build. Okay, so there's apportionment issues when you
So
start
basically
looking at
that's
interest. That's probably a whole nother webinar you could talk about. Interest limitation rules.
Were there any other questions that you spotted that would be? They're the two of the. There are quite a few here.
Maybe Stacey could add.
Stacey, are there other ones that you? This one here from Emma, maybe. Sorry.
Yeah, I was going to say that one from Emma. Is a relocated house considered a new build?
Yeah, I think as long as it's had, because presumably now I'm not I haven't done any sort of land deals myself, but I assume that when you relocate that building onto land, you still got to get issued with CCC.
You're going to have probably new titles on that.
Yeah, it's more the triple C. I can't answer that. Well, I know what I would say, but I'm not going to say.
Because that'll be basically be your answer. Because if you get because you know the whole thing about the new bright line rules reducing to 5 year for new builds, the interest.
I thought it was new titles only.
Yeah.
No, it's to do with triple C.
No, it's to do with the triple C.
Oh, yeah.
Because the whole thing around this is about they don't want to discourage increasing the rental supply. So if you say buy a piece of bare land and then you add a dwelling to the land after you buy it, it should, as long as the CCC is within the right period, then that should qualify as new build land, and then subject to both ongoing interest deductibility as well as a 5 year bright line.
Yep, people are saying here, yes, it requires a triple C. Yes, relocation gets triple C.
That's where all the experts are out there.
Yeah. But again, this is the
Cool. Was there any other questions there?
There are quite a few, but I'm not sure.
I've had questions asked to me about the interest deduction rules where people are just like putting something in their garage or that it's certainly not self-contained and that sort of thing, and those sort of things.
So basically, if you get a renovation and you get new CCC,
it's a new build.
It's got to be self-contained. So if you're just going to renovate a property, they're not going to, you haven't added a new self-contained dwelling to your land. So it's unlikely to satisfy.
A new reclad provides a triple C, a new code of.
No, but it's still got to basically increase the occupancy of your land. I guess another way of putting it. You've got to be adding new stock to the market, and that's what the government doesn't want to discourage by then taking away your interest deductions or having
so if you repile your house.
Anyway, there's another question here that's I hadn't touched on it, but it may be of interest to some, and that is 20 hectares of farmland farmed for 40 years.
Okay.
Would the option be better to develop into housing self, or sell the land as a whole to a third party? Also, if that land was inherited then, within a few years of getting it in will, would there be implications if if it was to be developed. So
Farmland one.
farmland
Yeah.
that 20 hectares has been farmed for 40 years, and are they going to, are they best to sell it as a lot or to develop it?
Okay, so there's quite a bit in there as well. Because a lot of, if you actually look at a lot of the tax cases on both CB12 and CB13, they actually deal with farmland that's been cut up into, into lots. Now here, of course, CB12 won't apply because the land's been owned for many years, but CB13 can still potentially apply.
Change of
Private
use, maybe?
Well, if you were going to do a significant residential development and then sell a whole lot of lots, you're likely to trigger both CB13 because if you're looking at the exclusions that apply to section CB13, clearly this farmland is not business premises as defined. To qualify for the farmland exclusion, you basically got to sell it as an economic farm that your purchaser is going to carry on farming. Okay, so clearly if you're dividing it up into residential lots, that's not going to apply. Naturally, you can't claim the residential exclusion because that requires you to have less than 4,500 square metres of your original lot. And then the other one is your investment income exclusion, where you're not going to hold, assuming you're going to sell these lots when you carve them up, then you're not going to be able to claim the investment income exclusion either. So more than likely, you're going to trigger section CB13 here, unless you're not going to exceed the significant expenditure benchmark. So that's going to come down to how many lots you're going to create, and can you stage it? So could you get away with selling it before it becomes taxable? And again, the number of lots, even though you've owned it for so long, you're going to trigger a taxable activity for GST.
I think what you're saying is tax advice. So we need to avoid that.
It's just avoiding the self-promotion.
Maybe we can have one more question in there. Maybe Stacey, if you can read us one more question from the audience.
Yeah, there's one here that will be relevant. If completing a one-lot subdivision off an existing site with a rental, with future intention to build for a rental on the new site, is there any tax implications for just sitting on the new vacant lot for a few years before building the rental?
Can you just go through that slowly again?
Yeah, so they're completing a one-lot subdivision off of an existing rental site with future intention to build a rental on the new site, but they want to sit on that vacant lot for a few years before building. Are there any tax implications?
Yeah, so if you basically, this would be one of those scenarios where we go back to, what is your intent of doing the subdivision scheme in the first place? Because, and the revenue says it's, again, if you go and look at that IS 2008, I think it's covered in there. It talks about that the taxing provision applies if the purpose of your scheme of subdivision is to sell the land. So if you're doing a subdivision and then you're going to sit on the block and leave it as bare land, then arguably you're not doing that subdivision for the purpose of sale. Now, if I was wearing IRD's hat, I'd be saying, well, why did you do the subdivision then? Now your response here may be, and again, they're always going to have the benefit of hindsight. You may just be holding it as bare land because eventually you're going to have the cash flow to erect another dwelling on it and then rent that dwelling out. Okay, but if you held it for a period of time, put a dwelling on it, and then sold that dwelling straight away, I think you might be in a little bit of hot water because the revenue might just say, look, we just think you held on to it for a period of time, but actually when you did the subdivision, you always knew you were going to put a dwelling on it and sell it. Okay, so therefore none of the exclusions to CB12. Because I think, was this one a rental section or they lived on the land?
Rental, and both the existing and the new one are intent for rental.
Yeah, okay. So if the new one's going to be rented as well, then I would be. Now there is a little bit of noise here coming from various corners that the revenue may take a view that if your land is already deriving residential investment income and you undertake a subdivision to erect a new residential dwelling, which you're also going to rent out, that the purpose of your undertaking or scheme is not to derive residential investment income from the land, because you are already deriving residential investment income from the land. Now, I haven't had any cases challenged in that way, but I have heard whispers that the revenue is potentially taking that view. So if you're looking at that scenario, then you've got to try and look at it maybe a non-legislative exclusion, or you just go for it. You just claim that if you do sell that piece of land, you claim the residential investment income exclusion. In a way, yeah.
Awesome. Well, thank you, Richard, for coming on to the webinar series. Unfortunately, we ran out of time today. I know there's so many more things that we would love to dwell on and obviously talk about. Taxes, one of the most exciting things, of this month. But anyway, we will have lots of information about Richard in the show notes later on, and also the video will be posted tomorrow. So everyone that missed today's webinar will be able to view that again, and it will stay on the Subdivision New Zealand group forum. So thanks for coming again, and we'll see you guys all next month.
Awesome.
Thank you.
Thank you.
Thanks.